Welcome to the week ahead. This isn't a hype show, it's not a prediction contest, and it's definitely not a place where we try to trade every headline. Each week, we step back from the noise and focus on the signals shaping capital, policy, and markets over the long term, not just the next day. Think of this as your reset before the week begins. Now, this weekend, my family and I, we flew down to Florida to visit my brother. He lives in St. Petersburg, coaches golf, and we had a great trip. It was beautiful weather, time spent with family, and I was even able to sneak in a long run. Now, let me tell you, running 13 miles in the Florida sun, it's a little bit different than running at home here in Charlotte in March. And about 2/3 of the way through, I was feeling pretty rough. I started questioning my life choices, but I pushed through and I finished. Now, on the flight home, we hit some turbulence. And actually, for a moment, it was more than a little turbulence. The plane dropped a bit, the cabin got quiet, and you could feel everybody kind of tense up. And I'll be honest, my stomach, it dropped with it. But my almost 3-year-old son, Caden, he had a very different reaction. He was laughing. He thought the whole thing was fun. It was pretty crazy. He was bouncing in his seat like it was an amusement park ride. And then Dad's over here. I'm gripping the armrest, thinking about gravity and the engineering on this plane. And afterward, it really struck me how interesting that moment was. The turbulence, it was the same for both of us, but our reaction to it was completely different. Now, in the end, the plane kept flying exactly the way it was designed to, and markets can feel the same way. This week, the headlines are loud again. We've got oil prices, geopolitical tension with Iran, and questions about what the Federal Reserve might do next. It can feel like turbulence, but turbulence doesn't mean the system is failing. It just means you're flying through weather. So this week, I'm focused on 3 things: what rising energy prices actually mean, how markets historically respond to geopolitical shocks, and how we're positioning portfolios in response. Let's start with oil. Prices are moving towards $100 per barrel, and investors are watching closely in case conflicts disrupt the supply through the Strait of Hormuz. And we've talked about this. We've put out some communication and some information and blog articles around it. But it gets attention quickly because people feel it immediately at the gas pump, even myself. But today's energy picture looks very different than it did decades ago. The United States is now a net petroleum exporter, and this is really important. Oil prices, higher oil prices, they just don't hurt us as consumers, but they also support American energy producers. It encourages domestic production and helps keep more of that economic activity inside the U.S. economy. So in other words, the U.S. economy is far more insulated from global energy shocks than many people realize. Higher oil prices can absolutely create volatility, and we've seen it. But volatility doesn't automatically mean the economy is about to break. The second signal is geopolitics. Whenever conflict escalates somewhere in the world, investors, even myself, ask the same question: what does this mean for markets? Now, history gives us useful perspective. If we look back across almost 100 years of conflicts, from World War II to the Gulf War to more recent geopolitical shocks, markets have experienced short-term volatility, but the long-term trajectory has remained remarkably resilient, and that's so important. In many cases, markets dip initially and then recover faster than many investors expect. Now, that does not mean that geopolitics don't matter, because they do. It does matter. But historically, it has often proven to be more noise than signal, and that's the point that I want to really try to make here, especially when it comes to long-term investment outcomes. And remembering that perspective can help us as investors avoid emotional decisions when headlines move quickly. The third signal is not coming from the headlines. It's coming from how portfolios are positioned. And right now, our approach is really about refinement, not retreat. So we still like what we've liked. The broader economic backdrop remains reasonably constructive. Businesses, they're still growing. Companies are still earning money. And while prices rose quickly over the past few years, the pace of those increases has begun to slow in many areas. Growth is starting to cool. It's cooled from a bit earlier in the year, and energy prices are definitely adding to some of that short-term pressure. But overall, the foundation of the economy remains solid enough that we continue to maintain an overweight to equities in our prime portfolios. What has evolved slightly is how risk is expressed inside of those portfolios. So over the past year, we've already positioned portfolios for a more selective market environment. And we've been talking about this for a couple years now. But artificial intelligence is a good example. The opportunity is no longer simply buying broad technology exposure, because AI is beginning to separate companies that are improving productivity and margins from those still trying to catch up. So that kind of dispersion, it creates opportunity but it also means selectivity really matters more. Now, we've also made modest adjustments across regions and sectors, including a small increase in exposure to defense companies, because those continue to benefit from rising global defense spending. And every time we make these changes, we include our trade rationale and send that out so that our clients are informed, so that you're informed and you understand what's going on and why we're doing what we're doing. But that brings us back to geopolitics. And there's two things I want to just say about that. We see it, we monitor it closely, but as I mentioned earlier, history suggests geopolitical events, they're often something to acknowledge, not something that forces us to rewrite the entire investment playbook. And that's so important. So instead of reacting to every headline, our focus remains on building portfolios that stay diversified, that are selective and resilient enough to navigate whatever environment unfolds. Now, the biggest event this week is going to be the Federal Reserve's decision. Inflation is still running somewhat higher than policymakers would like, while economic growth has cooled from earlier in the year. Now, you add in rising oil prices to that mix, and the Fed faces a delicate balancing act. So the real question is not just whether they move interest rates, it's really whether their tone signals patience or pressure, and that's what we'll be paying attention to. Now, that moment on the plane stuck with me. Caden was laughing. I was gripping the armrest. Same turbulence, but very different reactions. And the reality was simple. The plane was built for it. Markets are built for turbulence too. We've got energy shocks, we've got geopolitical tension, and there's policy uncertainty. And those things are part of the journey. Your advantage as an investor, it's not predicting every bump along the way. It's having a plan strong enough that you don't panic every time the plane shakes. That's the discipline we try to bring to every portfolio that we build. And I'll be here next week to keep watching the signals that actually matter. Prepared, not surprised.